Hi, everyone. Welcome. Thank you for joining us today. Today, we are going to talk about taxes and financial aid. And joining me from the VITA program today is Darlena Tran. Would you like to introduce yourself, Darlena?
Sure. Hold on. Let me maximize my. See. I'll get full screen. There it is. There you go. Hi everyone. My name is Darlena. Hi Sonia.
Oh,
I am I'm a current master student in taxations, and I've been doing taxes for 4 years.
thank you. And my name is Sonia Ethersberg, and I am the financial literacy coordinator within the financial aid department. And I'll be talking during the second portion of our presentation today about how your financial aid and tax information interact when you apply for financial aid. And Darlena is going to talk to you about tax basics. Today I also have my our brand new student assistant for financial literacy. Her name is Lydia Lee, and she'll be helping us field questions toward the end of the presentation. So now I'm going to go ahead and hand it off to Darlena, and I'm going to go off camera to not distract.
All right. Thank you, Sonia.
Thank you.
Okay. Oh, do I have the control of the slide now? Oops. Sonia, you still there?
Sorry about that. I forget about the mute button. Let me go ahead and make you a co-host. But I can move the slides for you unless you have it open on your computer and want to share your screen.
No, can you move the slides for me? It's easier.
Sure, no problem.
Okay. All right. Okay, so now we are in the mid-season of 2020 tax year. A lot of we don't have much questions whether do I need to file taxes this year versus compares to other years. This year, a lot of people file taxes because there's pandemic and there's other stimulus check that we want to get ourselves into a situation so that it can get direct deposits to our bank account. So we always encourage a taxpayer to file taxes, even though they don't have to file the tax. So what do I mean? Do I have to file tax? Well, there is a number that is given out by the IRS. It's called a standard deductions. So if your income is lower than the standard deductions, then you don't need to file. Most of the case, but we go over the exception later. So if you receive a W-2 income and you're single, if your income is $12,400, you don't have to file your taxes. And if you are you and your spouse receiving a W-2 and your total income is $24,800, you don't have to file taxes. And let's go to married filing separately later. Let's go to head of household. If you're head of household, what I mean is a head of household. Head of households mean that you have dependents. You have your parents or a qualifying child that you take care of them. You support more than 50% of their support. Then you are head of household, and your income on a W-2 income is less than $8,650. You don't have to file taxes. And then qualifying widower. For qualifying widowers, if you qualify in that status, how do you qualify into that status? If you and your spouse, if your spouse pass away the 2020 tax year, you still get to file married filing joint for the year that your spouse passed away. But and then you get to claim the qualifying widow 2 years after the spouse passed away and you have a qualifying child. Okay, hold on now. Yeah, let's go back to married and filing separately. Yes, if you marry and filing separately, you have, even if your income is $5, you have to report. Um, why do uh, why do we want to report? So if you have a W-2, you work as a W-2, you have tax withholding. You file your taxes to claim all your refund back, all the taxes that you withheld through your work. So that's just one reason we encourage a taxpayer to file taxes. And let's say if you have a 1099, if someone paying you for the work that you done, they pay you through check or through cash, or or if you drive Ubers or Lyft and your income is less than 400, even though they don't issue you it's called a 1099 NEC, but I mean, if that is all income that you have and your income is more than $400, you still have to file taxes anyways, even though your threshold, the overall income is less than 12,400 if you're single. So remember, if you have a 1099 or a check, uh, someone give you a check without holding taxes, the total income needs to be, if it's over $400, you still need to file taxes. Another reason we encourage taxpayers to file taxes is just because of the scam and of the people trying to steal information. And if you file your taxes in, I mean, the IRS has your information. So it's more steps for the scammers and for fraud to steal your identity. Okay. Do dependents have to file? Okay. So actually we had to look at the chart, but dependents, you don't have to file, but there are certain cases where you have to file. Let's say if you withholding, if you have, if your parents claim you and you also work as a part-time, and you as a college student and you work part-time with a W-2, even though it's under 12,400, you don't have to file, but you withheld a tax from your work and you work only $5,000. So what you do is your parents can still claim you as a dependent. They will they will claim the education credit that you have. And you also can also file your own taxes, but under when we go over the form 1040 later, I show you there's a box where it says someone can claim me as a dependent, but you still file your own taxes to claim back all the taxes that you withheld through your employer. Okay. So for right here, this is for children and other dependents. So for the children, you must file right here. If your unearned income was over 2,750. So this is for the elders, for adults. So if your parents are 65 and older, so the parents have to file the taxes if they have an earned income of 2,750. Okay, and so the earned income right here, we know that the threshold for a regular age is from 25 to 65 is $14,050. And then so if if it just mark as 12,400, if you know that your income is 12,400, you look at the number and says whether you should file or not. And then your gross income is more than the unearned income or the earned income. So actually there's a lot of confusion about what is unearned income and what is earned income. The earned income is the money that you work for, your salary, your wages, your 1099, you work and you earn it. The unearned income, for example, your stocks, your unemployment, the one that you did not work for, but you get the money from. So those are called unearned income. Okay, and then let's go to the very bottom, the under age 65 and not blind, because I think most of us are here. I assume that it's under age 65 and not blind, because the age 65 and not blind, they have a different, another 1,300 to add to their deduction because of their age and because of their they blind. But most of us here are under 65. So if your unearned income was over $1,100 and your earned income was over 12,400 and your gross income is 12,000, is your earned income plus the 350. So if your gross income is more than 12,050, then you do have to file your tax. But again, this is whether to see if this is for a lot of late tax filers. Says I'm too busy. I'm not sure if I have to file taxes, and do I have to file? So we get lazy in the ways. But if you are somewhere around this number, you should always file. And plus, even if your income is not around the numbers on the chart, we always encourage a taxpayer to file. It's beneficial to you. I mean, if you file, you get your refund back for the tax that you withheld through your employers. And then there's nothing wrong with if you filing it. But if, let's say, you're not sure if you have to file or not, and you decided not to file, and then when the IRS decided that, oh, you have to file, then there's interest and there's penalty for failure to file your tax returns, then that will accrue and you will have to pay and you own the balance to the IRS. And you don't want to be in that situations. That's another reason we always encourage our taxpayer to file your tax, even though you do not have to file. Okay. So I think I talked about this. Why should I file? Okay. So first of all, because you already you withheld your taxes when you work as a W-2 employee. Before you started working, you fill out a form called W-4, and on that W-4 you have the withholding. So most of the time is you already have your taxes withheld from your salary. So you file to claim all those taxes back. Okay. And then if you make estimated payments for the year you have, estimated payment is usually for taxpayers who did not withhold tax, or who have more tax responsibility than they withheld, which means that you pay quarterly, you pay extra taxes quarterly to the IRS, so they withhold your taxes by the end of the year. You don't, if you pay more than what you should owe, then the IRS will refund the money back to you. But if you don't withhold enough, then there's a penalty for underpayment penalty. So if you make an estimate, for people who make an estimated payment, a quarterly estimated payment, you need to file your tax to get your money back. Okay. And you qualify for earned income credits. These credits right here, the next three credits, the earned income credits, the child tax credit, and the American Opportunity Credit. The credits are also divided into two portions. One is refundable and the other one is non-refundable. So what it means refundable is if your credit is more than your tax liability, then you get a refund back. For non-refundable credit, if your credit is more than your tax liability, it's only credit up to your tax liability. So for example, if your tax liability is $5,000, you have to pay back to the IRS, but your credit, because of your children, you have children, you have all these kind of credit together, and your credits is about 6,000. So if it's a refundable credit, then you get $1,000 in refund because your tax responsibility is only 5,000 and your credits is 6,000. So you get a refund back of 1,000. But for a non-refundable credit, again, so if your tax responsibility is 5,000 and you receive 6,000 in non-refundable credit, you don't get a refund back. You don't own to the IRS, you don't have a balance, but because the non-refundable credit, it balance out your tax liability, but you don't get a refund if you have a non-refundable credit. See, oh, and I want to mention about the rebate, recovery rebate credit. Another good reason why you should file. Um, a lot since a lot of things happened during 2020, and so there are a lot of taxpayers, a lot of my clients who don't receive the stimulus check, or they don't know where it went, where it goes, and because the stimulus check, the 2020 was based on the 2019 or 2018 tax year. So if you did not file, and so probably the IRS did not have the records of how much of your information, so they didn't send you a check, or they don't have the updated your information. So they didn't give you a check. If you missed out the first one or the second one, or if you have another baby in 2020 and you think you should entitle to more credit, this is the reason why you should file your 2020 taxes, because any of the amount that you think that you should not title, it will be recovered on the 2020 tax year. If you have a baby in 2020 and the 2019 you didn't have the baby, so you can claim that on your 2020 tax. But when you go to but when you go to file your tax, remember exactly how much you receive on your first stimulus check and how much you receive on the second. You need to remember the exact amount, or at least look into the record. The first one sent out around April 15, and the second one sent out around November. Because if you don't give out the exact number, the IRS will delay your tax returns if the amount is not correct. What you reported is not concurring with what the IRS have, then your refund will get delayed. Okay, so when you look on the 1040, can you look, you see the 1040, and under it, it says filing status. So look at single, married, filed jointly, married, filed separately, head of household, and qualifying widower. So those are the marital status that I talked about earlier, about that you have a different amount of standard deductions. So you usually file, you need to check on one of these boxes, and then go under there is, you see next is standard deduction on the far left. Standard deduction, yes, up a little bit. Okay, and then to where the word standard deduction is, look to the right here. Can you go up a little bit? You said, okay, someone can claim. I want to
What
point
line,
out.
What line
Yes,
do you want to
yes,
highlight?
yes. Go up a little bit. You says if you are a dependent, someone can claim you as a dependent. Go up there, almost there, up there. There you go. There you go. You see the box to the right a little bit to the box. There that one. Yes, that one. So that one is your parents. Usually for students, the parents claim you as a dependent. But if you worked and you withheld your tax and you still file if you can you should file your tax. And then if you file your tax and mark on that box says someone else already claimed you as a dependent, which your parents. Um, it is more advantageous for the parents to claim you as a dependent because if you file outside, if you file as a an independent person, you don't get, if you are under 25 years old, you don't get the earned income tax credit. So those are one of um, the requirement of the earned income tax credit is between from the age 25 and 65. And if you worked and you are still in college, most likely you're not qualified. So you just disqualify yourself from a credit. Okay. And so you that's that. And then to the right here, I want to probably line number 30. Line number 30. I know it's very small, but line 30 is the stimulus check that we have the when you go to when you go to file your taxes, we have to ask you this question: how much did you receive on your stimulus check? If you don't answer, you don't have this information, we cannot move forward and e-file your taxes at all. So you need to have that information for this year. Okay. Okay. So what is my tax filing status? Um, so if you are, it goes on the last day of the tax year. So let's say if you're single for the whole year and you married on December 31st, 2020, then your marital status will be married and filing joint. So it goes according to the last day of the tax year. Okay. And say right here, let me see. Okay. So if you are married, so now when you are married and only one spouse have income, you still need to report your spouse income, but you need to include your one person has income, but you need to input the information both the husband and his spouse. So everyone in one tax returns, even though one person only received the income. Okay. Okay. So head of households, I explained earlier. So if you're head of household, if you have a dependence, depend on what kind of dependence. A dependent is a qualifying child and your parents. So that is when you qualify for head of household. If you have a cousin who stay with you for the whole year, that is not head of household. You have a dependent, you qualify for other dependent credit, but that person is not your qualifying child. So you cannot claim a cousin or some stranger to live in your house and you claim head of household. Okay, because you have to let me see. Let's go to the very last point right here. The qualifying person is your dependent parent. He or she doesn't have to live with you. So if your parents live in the nursing home, and because one of the requirement um, for head of household is the person have to live with you more than half a year, and your parents they live in a nursing home, it still counts as living with you. Same thing with for the children. Um, Same thing with for the children. If you go to college and you live in the dorm and your parents claim you, they still can claim you as dependent and living with you living with them for more than half the year or for the whole year. Okay. Okay. Why does head of households and what does head of household entail? So first of all, you file a separate return. So head of household is mean a single person claiming dependence. So that's mean you're head of household. Because if you are married filing joint, if you have your spouse with you, then you file married filing joint, not head of household. So head of households mean a single person having dependence, having qualifying dependence, then that is head of household. And then you pay more than half of the cost keeping your home for the tax year. Um, we have we have clients who comes in and the income is about $8,000 per year. Okay. And it says, can I claim head of the household? And even though the person they live with the taxpayer live with his parent the parents live with the taxpayer and they stay more than half the year, but because the parent they receive their own social security benefits, they have their own fund, the government support them. So the taxpayer cannot claim the parents because one of the reason here is that the taxpayers does not support more than 50% of the support to his parents. So therefore, the taxpayer does not qualify to claim the parents as head of household. So there's certain requirements that a head of households need to be fit in to claim the status. Okay. Okay. After knowing your tax filing status, prepare your documents. Okay, such as you need to have your ID. Um, a lot of times we have to verify proof, and if you go to any tax filing place and you have a refund and you do refund transfer, they require a photo IDs. I need to know your ID, your issue date, the expiration date. They need to verify that it's you to prevent the identity theft. You have social security cards for everyone in your on your tax returns, not just you and your spouse. If you have dependents, you have your parents, you have your kids, you need to have their birth dates, you need to have their social security and a proof of ID. And also for parents trying to claim dependence, if you have a child, says you need to have proof that the child live with you, um, or like what are the proof? The health records, the school records, all that to prove that the children live with you, because that will come in handy if, let's say, if you are a divorced parents and you claim another child, and so if one of the parents trying to claim the child for the credits, then you need to prove that the child lives with you. So we ask all kind of that documentation to prove that the child is yours and you are the custodial parent. You can is in a legal way that you are claiming the child. Okay? And also, what is it? You need to have bring in your health insurance, because it's required the law, both the federal and the state of California require that you have to have health care. If you don't have health care, you get penalized. And for if you let's see, if you are a marketplace, it's called Cover California, you pay, you get a form 1095A. And if you have Medi-Cal or Medicare, you get 1095B. And then you also get the 1095C if the employer sponsor your health insurance. Okay. What is a W-2? Well, let's compare the W-2 versus the 1099. I'll get an example of a 1099 is when you drive Uber or Lyft. So whatever the amount that they sent you, that let's say if you or if you're a commission, if you usually you do sales, let's say if you sell a product, you get 20% commission on a product, and you get that if you a product is $100 and your sales commission is $20, and so those $20 are not taxed yet. So those are it's called 1099 NEC. Before it used to call miscellaneous, but now it's NEC. Yes, we'll come back to that. Okay, and then so that $20 is not tax. So when you file your tax, you have to pay tax on that self-employment tax, which include the it's called the Social Security tax and the Medicare tax. So you have to pay those taxes, and because if you are 1099, and you see you both the employer and the employee, so therefore you pay the portion the FICA tax for the employer portion and the employee person. So the total taxes that you need to pay is 15.3% if you are a 1099 employer and employee. You have a 1099 income, so that means you don't have taxes yet. Okay, so now what is the difference with the W-2 income? So let's go back to the W-2 income. So this is the the form. Can you go to the next one? The form, the W-2 form. Yes, this one. So at the end of the year, you receive this income, this paper. So this paper is show that wages, that is how much your income is like for the year. And you see on box number 4 and number 6 and number 2. Okay, so the number 2 is when you fill out your W-4 income before you get hired. You fill out your W-4 income and you want how much the employer you indicate how much you want the employer to withhold for your taxes. So this is for you to pay. This is called the income tax. So at the end of the year, if you withheld more than what your liability is, you get your refund back. And if you don't withheld enough, then you get a balance owed back to the IRS. So number 4 right here, down to number 4 is the wages. So this wages right here is your portion that you already pay to as an employee. Excuse me, as an employer, you already pay to Social Security tax. And number 6, as an employee, you already pay your Medicare tax. So from, let's say on box number 1, your wages, let's say you receive $100,000 of income, or let's say 120,000 of dollars income. So which means that each month you receive about 10,000 of income. Okay, so with this 10,000 of income, that is supposedly on the paper that you receive 10,000 of income, but your actual paycheck, you don't receive the whole 10,000. You only see about 8,000, 8,500, or a different amount that's lower than 10,000. The reason was that because of the Social Security and Medicare tax was already taken out from your paycheck, and your federal withheld tax was also withheld for you by the employer to take it out for you. So that box number 1, even though you're supposed to receive the 10,000 per month, but your actual paycheck is not 10,000. Your actual paychecks were probably around 8,500, or it depends on how you withhold more, but it would be less than what it shows on the paper. So this is the main difference between the W-2 and the 1099, because the W-2, it says your salary is 10,000 per month and you only receive 8,500 per month. But if it's a 1099, then you receive the whole full $10,000 per month. But at the end of the year, you have to pay the tax doubles, because you have to pay twice as the Social Security tax and twice as the Medicare tax, because you are an employer and the employee. Okay. Okay. So let's go back to the tense the slide. A lot of
Right.
people.
Darlena,
Uh-huh.
I just want to let you know that there's for your section, there's about maybe 10 minutes or so left and a number of slides. So
Okay, we move quick.
should we go to the educational
We-
credits, or I think you talked about the 1099 NEC.
okay. Okay, let's move quick. I didn't know time go by so fast. Okay.
Thank you.
All right, so there are two types of educational credit, the lifetime learning credit and the American Opportunity Credits. As a student, if you are pursuing a first 4 years degree, it is beneficial for you to claim the more beneficial for you to claim the American Opportunity Credit than the lifetime learning credits. But because there's more credit to American Opportunity Credit, and partially of it is a refundable credit. So there are certain requirements that you need to be in order to qualify for American Opportunity Credit. Okay, so the slide is life learning credits. Okay, I'm sorry, I did not look at the slides. Okay, the lifetime learning credit is is for any classes that you take. For it doesn't matter if you are a graduate student, a postgraduate, or before before graduates. But if you take a credit and you want to, if you are the threshold in trying to claim the lifetime learning credit, because you can claim it anytime, and it's only one lifetime learning credit per tax return. Okay, and you're not eligible if you are a dependent or a married file separately. Okay, let's go to the American Opportunity Credit. Okay, so this one is more beneficial, but you have to be the first 4 year of college, and you can only claim it 4 years. So let's say if you go to community college 3 years and you transfer up to Cal State or university 2 years, trying to see whether it's more claim it on your second year of your community college, because usually the fees for Cal State and University are much higher um, than the community college. So if you pay out of your pocket more, you get to claim more on your credit. So be just strategic with when you want to claim this credit, because it's only given out only 4 years to undergrad. The first bachelor degree, if you get a second bachelor degree, you're not qualified. It's only the first undergrad degree. And there's one thing that I want to note here is that you will not qualify for the American Opportunity Credit if you were charged with a felony charge. So that is one point where the educational credits require that you do not have a felony charges against you. If you do, you automatically disqualify from this credit. Okay. Okay, so what is Form 1098T? If you're a student, you'll be most likely you are familiar with this. And when you go file taxes, a lot of tax preparers ask, do you have your Form 1098T? So the Form 1098T is, it gives you, um, the status of you are a student, a graduate student, a half-time, more than full-time student, or more than half-time student or full-time student, and how much you pay for your tuition and how much you receive for the scholarship, if you have any, or grant or assistance. Okay. Can you move to the next one? Oh, I see the red. Are financial aid funds considered considerable taxable income? So it depends. If you receive grants, that's government assistance, is not taxable. So if you are grant, It's not taxable income. If the scholarships depend on what kind of scholarship. If most of the scholarships are not taxable. So the scholarships is cover tuitions, fees, and boards. But let's say if you go to work and your employer pay for, give you a scholarship to pay for your tuition, it is a taxable income if your employer pay for it. So it depends, but most of the scholarships are non-taxable, and the grants are non-taxable. Okay, so just a little bit here, you see box number one. Box number one, it shows how much you pay for your tuitions. And then box number 5, it indicates how much you receive the scholarships or grants. So everything gets reported. And then if you look at box number 8, it says check if you're at least half-time students. So if you are less than a half-time student, you are not qualified to most of the scholarships. Most of the scholarships and the credits. And then it's number 9 is just graduate students. So this form right here is indicates your student status that tell us whether your income is taxable or not. And then the unemployment income. So it's box we see box number 1. So the new laws coming out for it just passed yesterday that if you receive unemployment income, so 10,200 will be non-taxable. So if of you and your spouse, so total that will be $20,400 non-taxable, but it must be each 10,200 must be per person. So if let's say if you are receiving about 5,000 of unemployment, but your spouse receiving $15,000 of unemployment, then it's not your spouse still only the 10,200 will qualify for as non-taxable, and yours is whole 5,000, not the two combined. Okay. And let's see, to withhold 10%. For the unemployment, is always withhold. Do withholding. Don't always check withholding. You will get a refund back if you don't have enough withhold. If you pay more than what you should pay for, but unless you get a refund back. But if you don't have a withholding and then there's a balance, a big balance that you owe at the end of the year, and you cannot pay before April 15, and there's interest penalties incurred, we don't encourage that. So always just withhold your 10% withholding with the unemployment.
Thank you so much, Darlena. I'm going to talk about the next section, which is how your financial aid interacts with your tax and income and where that falls into the financial aid application